Welcome to this life and health insurance exam review, powered by Birdsy, your AI study partner. Like and subscribe for more exam prep, and don't miss what's happening in the lower corner. It could be key to passing your exam. Let's get started.
General insurance concepts: risk, peril, hazard, and methods of handling risk. What is the primary purpose of insurance in relation to risk? Is it A, to transfer risk, B, to eliminate risk, C, to increase risk, or D, to avoid risk? The answer is A, to transfer risk. Insurance is designed to transfer risk from an individual or entity to an insurance company, which pools risks to manage them effectively. A homeowner installs a security system to reduce the chance of burglary. What risk management method is being used? Is it A, risk transfer, B, risk avoidance, C, risk reduction, or D, risk retention? The answer is C, risk reduction. Installing a security system is a form of risk reduction, as it decreases the likelihood of a burglary occurring.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
Which of the following best describes a peril in insurance terms? Is it A, a condition that increases risk, B, an event that causes a loss, C, a method of managing risk, or D, a type of insurance policy? The answer is B, an event that causes a loss. A peril is an event or circumstance that can cause a loss, such as fire or theft. Which method of handling risk involves setting aside funds to cover potential losses? Is it A, risk transfer, B, risk avoidance, C, risk reduction, or D, risk retention? The answer is D, risk retention. Why this question may seem a bit tricky. Risk retention is often confused with risk transfer, but retention involves keeping the risk and preparing financially for potential losses. Insurable interest and underwriting basics. What is the primary purpose of insurable interest in an insurance contract? Is it A, to increase the premium amount, B, to prevent insurance from being used as a gambling tool, C, to ensure the insurer makes a profit, or D, to reduce the risk of fraud? The answer is B, to prevent insurance from being used as a gambling tool. Insurable interest ensures that the policyholder has a legitimate interest in the preservation of the insured item or person, preventing insurance from becoming a gambling mechanism. John wants to insure his neighbor's house because he believes it will increase in value. Can he obtain an insurance policy for it? Is it A, yes, if he pays the premium, B, yes, if he gets permission from his neighbor, C, no, because he lacks insurable interest, or D, no, unless he is a co-owner? The answer is C, no, because he lacks insurable interest. John cannot insure his neighbor's house because he lacks insurable interest. Insurable interest requires a direct financial stake in the property. In underwriting, which factor is least likely to be considered when determining the insurability of a person? Is it A, medical history, B, occupation, C, age, or D, favorite color? The answer is D, favorite color. Why this question may seem a bit tricky. All options might seem relevant, but the person's favorite color is irrelevant to risk assessment and insurability. Life insurance basics and policies. Types of life insurance policies: term, whole, universal, variable? What is a key feature of term life insurance? Is it A, B, it provides coverage for a specific period, C, premiums increase annually, or D, it offers lifetime coverage? The answer is B, it provides coverage for a specific period. Term life insurance provides coverage for a specific period and does not build cash value. It is typically less expensive than permanent life insurance options. Which type of life insurance policy allows the policyholder to adjust the death benefit and premiums? Is it A, term life insurance, B, whole life insurance, C, universal life insurance, or D, variable life insurance? The answer is C, universal life insurance. Universal life insurance offers flexibility in adjusting the death benefit and premiums, making it adaptable to the policyholder's changing needs. What distinguishes variable life insurance from other types of life insurance? Is it A, it has a fixed interest rate, B, it offers guaranteed cash value growth, C, it provides a fixed death benefit, or D, it allows investment in subaccounts? The answer is D, it allows investment in subaccounts. Variable life insurance allows policyholders to invest the cash value in various subaccounts, which can affect the policy's cash value and death benefit. John wants a life insurance policy that provides lifetime coverage and builds cash value. Which type of policy should he consider? Is it A, whole life insurance, B, term life insurance, C, universal life insurance, or D, variable life insurance? The answer is A, whole life insurance. Whole life insurance provides lifetime coverage and builds cash value over time, making it suitable for John's needs.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Which life insurance policy type is typically the least expensive for young individuals seeking temporary coverage? Is it A, whole life insurance, B, term life insurance, C, universal life insurance, or D, variable life insurance? The answer is B, term life insurance. Why this question may seem a bit tricky, term life insurance is often the least expensive option for young individuals seeking temporary coverage, but the term temporary might mislead some to consider other options. What is a primary characteristic of whole life insurance? Is it A, lifetime coverage with cash value, B, coverage for a specific term, C, flexible premiums and death benefits, or D, investment options within the policy? The answer is A, lifetime coverage with cash value. Whole life insurance provides lifetime coverage and includes a cash value component that grows over time. Premiums are typically fixed and do not increase with age. Lisa wants a policy that allows her to invest in separate accounts and potentially increase her cash value. Which type of life insurance should she choose? Is it A, term life insurance, B, whole life insurance, C, variable life insurance, or D, universal life insurance? The answer is C, variable life insurance. Variable life insurance allows policyholders to invest in separate accounts, similar to mutual funds, which can increase cash value based on market performance. Which type of life insurance policy typically requires the policyholder to manage investment choices? Is it A, term life insurance, B, whole life insurance, C, universal life insurance, or D, variable life insurance? The answer is D, variable life insurance. Why this question may seem a bit tricky. The term manage investment choices might confuse some with universal life, but it's specific to variable life insurance, where policyholders choose how to invest cash value. Life insurance uses and needs analysis. What is the primary purpose of conducting a life insurance needs analysis? Is it A, to determine the amount of coverage needed? B, to compare different insurance companies? C, to calculate the premium cost? Or D, to assess the policyholder's health? The answer is A, to determine the amount of coverage needed. The primary purpose of a life insurance needs analysis is to determine the amount of coverage necessary to meet the financial needs of beneficiaries in the event of the policyholder's death. Which of the following is a common method used in life insurance needs analysis? Is it A, asset allocation, B, human life value, C, risk assessment, or D, market analysis? The answer is B, human life value. The human life value approach estimates the economic value of a person's future earnings, which helps determine the appropriate amount of life insurance coverage. John is the sole breadwinner for his family. He wants to ensure his family can maintain their lifestyle if he passes away. Which life insurance concept should he focus on? Is it A, estate planning, B, investment growth, C, income replacement, or D, tax reduction? The answer is C, income replacement. John should focus on income replacement, which ensures that his family can maintain their standard of living by replacing his income if he dies. What is a key factor in determining the amount of life insurance coverage needed? Is it A, the insured's age, B, the insured's health, C, the insured's occupation, or D, the insured's financial obligations? The answer is D, the insured's financial obligations. A key factor is the financial obligations and goals of the insured, which help determine the necessary coverage to meet those needs. Why might a policyholder choose a decreasing term life insurance policy? Is it A, to increase coverage over time, B, to match decreasing financial obligations, C, to reduce premium costs annually, or D, to provide a cash value component? The answer is B, to match decreasing financial obligations. Why this question may seem a bit tricky, decreasing term insurance is often chosen to match decreasing financial obligations, like a mortgage, which can confuse those who think coverage should always remain level. What is the primary factor in determining the amount of life insurance coverage needed for an individual? Is it A, the individual's age, B, the financial needs of dependents, C, the individual's health status, or D, the individual's occupation? The answer is B, the financial needs of dependents. The primary factor is the financial obligations and needs of the individual's dependents, ensuring they can maintain their lifestyle in the event of the policyholder's death. Sarah is evaluating her life insurance needs to ensure her children's education is covered if she passes away. What should she focus on in her needs analysis? Is it A, her current income, B, her retirement savings, C, future education costs, or D, her current debts? The answer is C, future education costs. Sarah should focus on calculating the future education costs to ensure her life insurance policy covers these expenses adequately. Health insurance basics and policies. Types of health insurance policies: medical expense, disability, LTC. What is the primary purpose of long-term care insurance? Is it A, to cover hospital expenses, B, to provide coverage for extended care services, C, to replace lost income due to disability, or D, to pay for prescription medications? The answer is B, to provide coverage for extended care services. LTC insurance is designed to cover services needed for individuals who cannot perform basic daily activities due to chronic illness or disability. Which type of health insurance policy is specifically designed to provide income replacement? Is it A, medical expense insurance, B, long-term care insurance, C, disability insurance, or D, accidental death insurance? The answer is C, disability insurance. Disability insurance provides income replacement when an individual is unable to work due to illness or injury. What is a key feature of medical expense insurance? Is it A, covers hospital and physician services, B, provides a lump sum for critical illness, C, replaces income during disability, or D, pays for long-term care services? The answer is A, covers hospital and physician services. Medical expense insurance primarily covers costs associated with hospital stays, surgeries, and physician visits. John is unable to work due to a severe back injury. Which type of insurance policy would help replace his income during this period? Is it A, medical expense insurance, B, long-term care insurance, C, critical illness insurance, or D, disability insurance? The answer is D, disability insurance. Disability insurance provides income replacement for individuals who cannot work due to injury or illness. Which insurance policy is least likely to cover routine dental checkups? Is it A, dental insurance, B, medical expense insurance, C, disability insurance, or D, long-term care insurance? The answer is B, medical expense insurance. Why this question may seem a bit tricky, routine dental checkups are typically covered by dental insurance, not by medical expense, disability, or LTC insurance. What is the primary function of medical expense insurance? Is it A, to cover medical care costs, B, to provide income replacement, C, to pay for long-term care, or D, to cover routine dental checkups? The answer is A, to cover medical care costs. Medical expense insurance is designed to cover the costs associated with medical care, such as hospital stays, surgeries, and doctor visits, reducing the financial burden on the insured. Sarah has been diagnosed with a chronic illness that requires ongoing treatment. Which type of insurance policy would best help her manage the costs? Is it A, disability insurance, B, long-term care insurance, C, medical expense insurance, or D, accidental death insurance? The answer is C, medical expense insurance. Medical expense insurance is suitable for managing costs associated with ongoing medical treatments as it covers hospital and doctor visits. Which type of health insurance policy is least likely to cover elective cosmetic surgery? Is it A, disability insurance, B, long-term care insurance, C, accidental death insurance, or D, medical expense insurance? The answer is D, medical expense insurance. Why this question may seem a bit tricky, elective cosmetic surgery is generally not covered by standard health insurance policies, including medical expense insurance, unless deemed medically necessary. Group versus individual health coverage. What is a primary advantage of group health insurance over individual health insurance? Is it A, lower premiums due to risk spreading, B, more personalized coverage options, C, guaranteed acceptance regardless of health, or D, higher coverage limits? The answer is A, lower premiums due to risk spreading. Group health insurance often offers lower premiums because the risk is spread across a larger number of people. Which of the following is typically true about individual health insurance policies? Is it A, they are always cheaper than group policies? B, they often require medical underwriting? C, they are only available through employers? Or D, they provide coverage for pre-existing conditions without restrictions? The answer is B, they often require medical underwriting. Individual policies often require medical underwriting, which can affect eligibility and premiums. What is a common feature of group health insurance plans? Is it A, higher premiums for older employees? B, individual underwriting for each member? C, open enrollment periods? Or D, coverage limited to full-time employees only? The answer is C, open enrollment periods. Group plans often have open enrollment periods where employees can join without medical underwriting. An employee is considering switching from their employer's group health plan to an individual plan. What is a key factor they should consider? Is it A, the availability of dental coverage? B, the number of dependents covered? C, the network of healthcare providers? Or D, the cost and coverage differences? The answer is D, the cost and coverage differences. Individual plans may have higher premiums and different coverage options compared to group plans. Why might an individual choose a group health insurance plan even if they have access to a cheaper individual plan? Is it A, group plans always have lower deductibles? B, group plans may offer more comprehensive coverage? C, individual plans never cover pre-existing conditions? Or D, group plans are always more flexible? The answer is B, group plans may offer more comprehensive coverage. Why this question may seem a bit tricky. Cheaper isn't always better. Group plans often offer more comprehensive coverage and stability. What is a typical characteristic of group health insurance plans? Is it A, higher premiums than individual plans? B, lower premiums due to risk pooling? C, limited coverage options? Or D, no employer contribution? The answer is B, lower premiums due to risk pooling. Group health insurance plans often offer lower premiums because the risk is spread across a larger number of people, making it more cost-effective for insurers. Which factor is least likely to affect the premium of an individual health insurance policy? Is it A, age of the insured? B, health status of the insured? C, geographic location? Or D, number of employees in a company? The answer is D, number of employees in a company. Why this question may seem a bit tricky. Premiums are influenced by personal factors like age and health status, but not by the number of employees, which is relevant to group plans. Policy provisions, options, and riders. Standard provisions and required clauses. What is the primary purpose of the incontestability clause in a life insurance policy? Is it A, to prevent insurers from voiding the policy after a certain period? B, to allow policyholders to change beneficiaries at any time? C, to ensure premiums remain level throughout the policy term? Or D, to provide a grace period for premium payments? The answer is A, to prevent insurers from voiding the policy after a certain period. The incontestability clause prevents insurers from voiding a policy after a specified period, typically 2 years due to misstatements by the insured. Which provision allows a policyholder to change the beneficiary of a life insurance policy? Is it A, incontestability clause? B, grace period provision? C, change of beneficiary provision? Or D, misstatement of age clause? The answer is C, change of beneficiary provision. The change of beneficiary provision allows policyholders to alter the beneficiary designation unless the beneficiary is irrevocable. John's life insurance policy includes a misstatement of age clause. If his age was misstated on the application, what will the insurer do upon discovery? Is it A, void the policy immediately? B, adjust the benefits or premiums to reflect the correct age? C, increase the death benefit? Or D, require a new application? The answer is B, adjust the benefits or premiums to reflect the correct age. The misstatement of age clause allows insurers to adjust the benefits or premiums to reflect the correct age rather than voiding the policy. Which provision in a life insurance policy ensures that the policy remains in force even if a premium payment is missed? Is it A, incontestability clause? B, misstatement of age clause? C, reinstatement provision? Or D, grace period provision? The answer is D, grace period provision. Why this question may seem a bit tricky. The grace period provision is often confused with other clauses, but it specifically allows a short period after the due date to make a payment without losing coverage. What does the entire contract provision in a life insurance policy include? Is it A, only the policy document? B, the policy document and any attached application? C, the policy document and all verbal agreements? Or D, only the application? The answer is B, the policy document and any attached application. The entire contract provision includes the policy document and any attached application, ensuring no external documents can alter the contract. Which provision in a life insurance policy allows the insurer to adjust the death benefit if the insured's age was misstated on the application? Is it A, incontestability clause? B, grace period provision? C, misstatement of age provision? Or D, entire contract provision? The answer is C, misstatement of age provision. Why this question may seem a bit tricky. The misstatement of age provision specifically addresses adjustments to the death benefit due to incorrect age information, not other factors like health or occupation. Common policy riders and settlement options. What is the primary purpose of a waiver of premium rider in a life insurance policy? Is it A, to waive premium payments during disability? B, to increase the death benefit? C, to provide additional coverage for dependents? Or D, to allow partial withdrawals from the policy? The answer is A, to waive premium payments during disability. A waiver of premium rider allows the policyholder to stop paying premiums if they become disabled, ensuring the policy remains in force. Which settlement option provides the beneficiary with regular income for life? Is it A, lump sum payment? B, life income option? C, fixed period option? Or D, interest-only option? The answer is B, life income option. The life income option provides the beneficiary with regular payments for the rest of their life. What does an accidental death benefit rider typically provide? Is it A, coverage for terminal illness? B, waiver of premiums during disability? C, additional payout for accidental death? Or D, conversion to a whole life policy? The answer is C, additional payout for accidental death. An accidental death benefit rider provides an additional payout if the insured dies due to an accident. John has a life insurance policy with a guaranteed insurability rider. What can he do with this rider? Is it A, receive a loan against the policy? B, convert the policy to a term policy? C, waive premiums if disabled? Or D, purchase additional coverage without proof of insurability? The answer is D, purchase additional coverage without proof of insurability. The guaranteed insurability rider allows John to purchase additional coverage without proving insurability. Which rider allows a policyholder to access a portion of the death benefit if diagnosed with a terminal illness? Is it A, waiver of premium rider, B, accidental death benefit rider, C, guaranteed insurability rider, or D, accelerated death benefit rider? The answer is D, accelerated death benefit rider. Why this question may seem a bit tricky. The term accelerated can be confused with other riders. The accelerated death benefit rider specifically allows access to the death benefit upon terminal illness diagnosis. Annuities and retirement plans. Fixed, variable, and indexed annuities. What is a primary characteristic of a fixed annuity? Is it A, guaranteed rate of return, B, investment in mutual funds, C, potential for high returns, or D, linked to stock market performance? The answer is A, guaranteed rate of return. A fixed annuity provides a guaranteed rate of return, making it a stable investment option. This is in contrast to variable annuities, which fluctuate with market performance. Which type of annuity allows for investment in a separate account with a choice of sub-accounts? Is it A, fixed annuity, B, variable annuity, C, indexed annuity, or D, immediate annuity? The answer is B, variable annuity. Variable annuities allow the owner to invest in separate accounts, similar to mutual funds, offering a range of sub-account choices. John has invested in an indexed annuity. If the stock market index increases by 5%, what will happen to his annuity's value? Is it A, it will decrease by 5%, B, it will remain the same, C, it will increase subject to caps, or D, it will increase by exactly 5%? The answer is C, it will increase subject to caps. Indexed annuities are tied to a stock market index, so their value increases with the index, subject to caps and participation rates. What is a potential downside of a variable annuity that might not be immediately obvious? Is it A, guaranteed returns, B, lack of investment options, C, immediate payout, or D, high fees? The answer is D, high fees. Why this question may seem a bit tricky. Variable annuities can have high fees, which might not be apparent initially. These fees can significantly impact the net returns over time. Qualified retirement plans and taxation basics. What is the primary tax advantage of contributing to a traditional 401 plan? Is it A, contributions are made with pre-tax dollars, B, contributions are tax-free upon withdrawal, C, contributions are matched by the employer tax-free, or D, contributions grow tax-free? The answer is A, contributions are made with pre-tax dollars. Contributions to a traditional 401 plan are made with pre-tax dollars, reducing taxable income for the year. This defers taxes until withdrawals are made during retirement. Emily, age 55, is considering withdrawing funds from her traditional IRA. What tax implication should she be aware of? Is it A, she will face a 10% early withdrawal penalty, B, withdrawals are taxed as ordinary income, C, withdrawals are tax-free, or D, withdrawals are taxed at a flat rate of 15%? The answer is B, withdrawals are taxed as ordinary income. Withdrawals from a traditional IRA are taxed as ordinary income. However, since Emily is over 59 and a half, she avoids the early withdrawal penalty. Which of the following is a characteristic of a Roth 401 plan? Is it A, contributions are tax-deductible, B, withdrawals are taxed as ordinary income, C, contributions are made with after-tax dollars, or D, employer matches are tax-free? The answer is C. Contributions are made with after-tax dollars. Why this question may seem a bit tricky, Roth 401 contributions are made with after-tax dollars, unlike traditional 401 plans. This can be confusing as both plans share the 401 designation.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Federal and state regulations. Insurance regulation and licensing. What is the primary purpose of state insurance departments? Is it A, to regulate the insurance industry and protect consumers? B, to set federal insurance standards? C, to provide insurance to state employees? Or D, to manage state pension funds? The answer is A, to regulate the insurance industry and protect consumers. State insurance departments are responsible for regulating the insurance industry within their state to protect consumers and ensure fair practices. Which entity is primarily responsible for licensing insurance agents? Is it A, the National Association of Insurance Commissioners? B, state insurance departments? C, the Federal Insurance Office? Or D, the Department of Labor? The answer is B, state insurance departments. State insurance departments are responsible for licensing insurance agents to ensure they meet the necessary qualifications and standards. An insurance agent is found guilty of fraud in one state. What action can other states take regarding the agent's license? Is it A, nothing, as each state operates independently? B, automatically revoke the license without review? C, revoke or suspend the license after review? Or D, require the agent to reapply for a new license? The answer is C, revoke or suspend the license after review. States can revoke or suspend the agent's license based on the fraud conviction, as they have the authority to regulate licenses within their jurisdiction. What is the role of the National Association of Insurance Commissioners in insurance regulation? Is it A, to directly regulate insurance companies? B, to issue insurance licenses? C, to enforce federal insurance laws? Or D, to provide a framework for state regulation? The answer is D, to provide a framework for state regulation. Why this question may seem a bit tricky. The NAIC does not regulate directly, but provides a framework for states to follow, which can be confused with direct regulation. What is required for an insurance company to operate in a particular state? Is it A, a federal insurance license? B, approval from the NAIC? C, a certificate of authority from the state? Or D, a state business license? The answer is C, a certificate of authority from the state. Insurance companies must obtain a certificate of authority from the state to legally operate and sell insurance within that state. What is the primary purpose of the McCarran-Ferguson Act in the context of insurance regulation? Is it A, to establish federal oversight of insurance companies? B, to create uniform insurance laws across all states? C, to affirm state authority over insurance regulation? Or D, to mandate federal insurance standards? The answer is C, to affirm state authority over insurance regulation. Why this question may seem a bit tricky. The McCarran-Ferguson Act is often misunderstood. It does not regulate insurance directly, but rather affirms that states have the authority to regulate insurance, except where federal law specifically provides otherwise. Marketing practices and producer responsibilities. What is the primary purpose of the National Association of Insurance Commissioners in regulating insurance marketing practices? Is it A, to develop model laws for uniform regulation? B, to enforce federal insurance laws? C. To provide insurance to high-risk individuals. Or D. To set insurance premium rates. The answer is A. To develop model laws for uniform regulation. The NAIC develops model laws and regulations to promote uniformity and consistency in insurance regulation across states. Which federal act requires insurers to provide a privacy notice to consumers? Is it A. The Affordable Care Act, B. the Gramm-Leach-Bliley Act, C. the McCarran-Ferguson Act, or D. the Fair Credit Reporting Act? The answer is B. the Gramm-Leach-Bliley Act. The Gramm-Leach-Bliley Act mandates that financial institutions, including insurers, provide privacy notices to consumers. What is the role of a state insurance commissioner in regulating marketing practices? Is it A. to set federal insurance standards, B. to sell insurance products, C. to enforce state insurance laws, or D. to provide legal advice to insurers? The answer is C. to enforce state insurance laws. State insurance commissioners enforce state insurance laws and ensure that marketing practices are fair and transparent. The producer is advertising a new life insurance policy. What must they ensure to comply with state regulations? Is it A. that the policy is the cheapest on the market, B. that the policy is approved by the NAIC, C. that the policy includes all possible benefits, or D. that the advertisement is truthful and not misleading? The answer is D. that the advertisement is truthful and not misleading. Producers must ensure that all advertisements are truthful and not misleading, adhering to state regulations on marketing practices. Which of the following is not typically a responsibility of an insurance producer under state regulations? Is it A. providing accurate policy information, B. setting premium rates for policies, C. maintaining a valid license, or D. complying with continuing education requirements? The answer is B. setting premium rates for policies. Why this question may seem a bit tricky. Producers have many responsibilities, but setting premium rates is not one of them, as this is typically done by the insurance company.
Don't forget to comment below with your tips, challenges, and thoughts on exam preparation. Your experiences can make a big difference for others.
Taxation of life and health products. Tax treatment of premiums, benefits, and proceeds. How are life insurance death benefits typically treated for federal income tax purposes? Is it A. exempt from federal income tax, B. subject to federal income tax, C. taxed at a reduced rate, or D. taxed only if over a certain amount? The answer is A. exempt from federal income tax. Life insurance death benefits are generally exempt from federal income tax, providing a tax-free benefit to the beneficiaries. What is the tax treatment of premiums paid for individual life insurance policies? Is it A. tax deductible, B. not tax deductible, C. taxed as ordinary income, or D. taxed at a rate? The answer is B. not tax deductible. Premiums paid for individual life insurance policies are not tax deductible, meaning they cannot be subtracted from taxable income. John receives a lump sum from his life insurance policy's cash value. How is this amount taxed? Is it A. solely taxable as income, B. tax-free, C. taxable on the amount exceeding premiums paid, or D. taxed at a capital gains rate? The answer is C. taxable on the amount exceeding premiums paid. The lump sum from a life insurance policy's cash value is taxable only on the amount exceeding the premiums paid. How are disability insurance benefits taxed if the premiums were paid with after-tax dollars? Is it A. taxed as ordinary income, B. Taxed at a capital gains rate. C. Partially taxable. Or D. Tax-free. The answer is D. Tax-free. Disability insurance benefits are tax-free if the premiums were paid with after-tax dollars. If a life insurance policy is transferred for value, how are the death benefits taxed? Is it A. Always tax-free? B. Taxable if transferred for value? C. Taxed only if the policy is over a certain value? Or D. Tax-free if transferred to a family member? The answer is B. Taxable if transferred for value. Why this question may seem a bit tricky. Normally tax-free, death benefits become taxable if the policy is transferred for value, except for certain exceptions. How are premiums for group life insurance policies typically treated for tax purposes when paid by the employer? Is it A. Tax deductible for the employer? B. Taxable income for the employer? C. Taxable income for the employee? Or D. Not deductible for the employer? The answer is A. Tax deductible for the employer. Premiums paid by an employer for group life insurance are generally tax deductible for the employer. However, the value of coverage over $50,000 is taxable to the employee. What is the tax treatment of benefits received from a health insurance policy? Is it A. Taxable as income? B. Not taxable? C. Tax deductible? Or D. Subject to capital gains tax? The answer is B. Not taxable. Benefits received from a health insurance policy are generally not taxable as they are considered reimbursement for medical expenses. Sarah receives a $100,000 death benefit from her father's life insurance policy. How is this amount treated for tax purposes? Is it A. Taxable as ordinary income? B. Subject to estate tax? C. Not taxable? Or D. Taxed as a gift? The answer is C. Not taxable. Life insurance death benefits are generally received tax-free by the beneficiary unless the policy was transferred for value. How are the proceeds from a life insurance policy loan treated for tax purposes? Is it A. Taxable as income? B. Tax deductible? C. Subject to capital gains tax? Or D. Not taxable? The answer is D. Not taxable. Why this question may seem a bit tricky. Policy loans are not taxable as income because they are considered a loan against the policy's cash value, not a distribution.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit Birdsy.ai for complimentary study sessions with Birdsy, your AI-powered study partner.